Advanced Financial Accounting. In this presentation, we're going to go through a consolidation process within Excel. This consolidation will be for a non-wholly owned subsidiary where there's no goodwill involved, and we're going to do the consolidation right after the point in time where the transaction took place where there is a controlling interest. In other words, we're going to have two organizations. One has a controlling interest in the other, therefore you have a parent-subsidiary relationship. However, it's not a wholly owned subsidiary. In other words, there's not 100% ownership. So there's going to be some portion that's not wholly owned within the consolidation process. Also note that there's not going to be any goodwill involved in this consolidation process. And we're going to go through this as we said in prior presentations when we look at these problems. We're going to add different levels of complexity as we go. So no goodwill in this case. And we're going to start at year zero. Meaning consolidation took place at the beginning of the year, we're going to say, and no time has passed since consolidation. We're just going to say, all right, now they're consolidated as of this point in time. Let's take those balance sheet accounts as of the point in time of consolidation and consolidate them right then and there. Then we're in another presentation, we'll take a look at the consolidation after a year's worth of activities. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We're going to have our information on the left-hand side. We're going to enter that information into the blue area on the right-hand side, including our consolidation entry here, or elimination entry, and our worksheet for the consolidation worksheet, and then our balance sheet after the consolidation information, left-hand side. P purchased 90% of outstanding stock on 1x0. So the beginning of the year, 90%. Didn't purchase 100%. P is one company, S is the other company. P is purchasing the stock of S. So they purchased for $344,700. We're going to assume cash in this transaction in this process. The book value of S was $383,000. Key different here than prior presentations, we're going to be adding kind of differences and levels of complexity as we go, is that 90% was purchased. We still have a full year, however, we're going to do the consolidation as of the beginning of the year right after consolidation, not as of the end of the year. There's no activity since the point of consolidation. Therefore, we're only going to be looking at basically balance sheet accounts. P uses the equity method to account for investment in S, so it's going to be using the equity method. Make consolidation balance sheet at acquisition date. Okay, so first let's consider basically goodwill calculations and the percentage of ownership since we have a controlling and non-controlling interest. Book value at purchase of S. So what was the book value as of the purchase of S? It was the 383. In other words, book value meaning assets minus liabilities as of the purchase date. So if I took the assets minus the liabilities here, 383,000, which is equal to the equity. So that's what's on the books right at the point of consolidation. The P company, which I kind of assume is us, right? I see ourselves as the purchaser here, of course. And we purchased 90% of the S company. So then we're going to say that the 383 times the 90% is going to be the 344.7. So 344.7 is what we paid. So notice in this consolidation, we're saying, all right, we're going to purchase 90% of the outstanding shares. If I looked at the value, and I'd say, all right, well, the assets minus the liabilities are $383,000, or in other words, the book value is $383. We'll take 90% of that and pay you $344.7. Now that would make sense. However, the book value is typically not, may not be, the fair value, and there could be goodwill involved. So that's a simplification that won't typically be what actually happens usually. So notice that's still going to be one of our kind of more simplified items that will adjust as we keep adding to complexity. So then we're going to say that the purchase price was the 344.7. So we paid 90% of basically the book value. That means there's no goodwill involved here. We paid just what the book value was. And then we're going to say that what about the non-controlling interests? Well, if you take the assets minus the liabilities, the 383, if we got 90%, then there's 10% out there that we don't have, the non-controlling interest. And that is, of course, going to be, if we multiply that, the 38.3. In other words, this 38.3 non-controlling interest added to the 344.7, the controlling interest at the point of purchase, is the 383,000, which is the book value, or in other words, which is assets minus liabilities for company S, or in other words, the equity value, the book value at the point of purchase. Okay, so then we have our two financial statements over here, we're just going to say we're going to reconcile this as of the date of consolidation. No income statement accounts down here. We just got the balance sheet accounts because no activity has happened thus far after consolidation. That'll be the next level of complexity problem that we'll take a look at next time. So we're just going to be summing these up then. I'm just going to say, all right, let's take P and S. Also note that they line up beautifully because, it's a book problem. In practice, they wouldn't line up as nicely, and we would have to then go in and line them up. Not a difficult task, but a tedious task to line up two different sets of books and have two different chart of accounts and line them up. Okay, so then we're going to, once we line them up, we're just going to sum up, say, add those up. Then we'll use the autofill to drag this down. So I'm going to use the autofill, which it's been being stubborn to me, but there it is. Auto drives it down. Dr. Phil does the calculation. So autofill. So there we have it. So now we're just summing these up, and that's basically the consolidation. No income statement accounts here. Now we got to do our elimination entries. Now the major elimination is going to be this item needs to be eliminated. There's no income yet. So the other side of this is just equity right now. So we're simplifying that because we have to add the new component, which is the non-controlling interest in the net assets of S. And it'll be easier to do that if we do that at the beginning of the year, then we'll add the complexity. So we're going to say, all right, and once again, I'm not going to be putting the debits on top and the credits on the bottom. I'm going to think through this in the way that makes the most sense to me. So we're going to have the investment in S. Investment in S, that's going to have to go off the books. That needs to go away. So we're going to credit that. That's, we know that has to happen. That's got to go away. We can't have a consolidation with an investment in ourselves. The other side of that is going to be in the equity section of S. And you'll recall that it's right at the point of purchase. So where did we get this 344.7? Where did P get that? Well, they debited 344.7 and credited cash at the point of purchase. And under the equity method or, a cost method, it would be the same because no other activity has happened thus far. So that 344.7 is the 344.7 that was paid in our problem over here. All right, so then we're going to have the common stock is going to go off the books. So common stock, we're going to say that's going to go off the books for company S. And what we're going to do is we're going to remove the entire amount. And you might say, hey, look, if I add those up, it adds up to 383. And this is only 344. This represents what proportion of the total? What proportion of the assets minus the liabilities? 90%, because that's what we purchased. We purchased 90% of the value. So, but I'm going to take it off the books for the full amount, and then we're going to record the difference as the non-controlling interest here. So we're going to consolidate everything, and then report the non-controlling interest as basically another line item. That's going to be the new thing. So I'm going to say, all right, so we're the controlling interest. I'm going to remove the entire equity at the point of purchase, which is this point at time 0. And then we're going to remove the entire retained earnings, part of the equity, as of this point. Even though we only own 90%, because again, I'm assuming we're P here with purchasers, owning 90%. And then we're going to add this other account in equity and say, now we're just going to break out the portion that we don't own, which we're going to call NCI in net assets of S, which is the non-controlling interest. So the non-controlling interest. So we're going to say, and then by the way, we don't own like this 10%. So there we have it. That's stuff that we had to include, but that's not ours, basically. That's stuff that we're including in the consolidation because we're required to do so, but it's not, we don't have claims to 10% of the assets. All right, so what does this look like when we post it? Let's do this. We're going to say the investment's still going to go off the books. That's the same as when we had 100% purchase. So I'm over here in L6. I'm just going to say, yep, the investment is now gone. The investment has now been removed. That makes sense. Now the other side is going to be in equity. It's times 0 so nothing has happened thus far, and we're going to take the entire equity of S off the books, even though we only purchased a portion of it. So we're going to debit then the 182. That means we had P 482 plus the 182, 644. Then we subtract out the 182 that we took out to give us the 484 that was P's portion. Then we've got the retained earnings. Retained earnings down here. That's going to be in L13 equals. Oh no, something happened. Hold on a second. Hold on. Okay. Equals. And then we're going to go over to that 201. 201 and remove that. So we have the 4097, the 201, that's the 6107. Then we remove the 201, bringing us back to the 4097, which is P's portion basically, right? And then we've got the non-controlling interest, and that's going to be for the 387. So in other words, we removed the entire portion at the point of consolidation for S, for the retained earnings, and then we put back on the books, basically in equity, the non-controlling interest. So we removed the whole thing and said, oh yeah, and then here's the 38,000. We'll put that back on for the non-controlling interest, and that of course will be the difference here, right? Or in other words, it'll be the 10%. So if I was to take assets minus liabilities, the 383, because we purchased it for exactly our portion, 90%, then the 10%, or if I took this, that's the 383. Then if we pull out the trusty calculator, as we calculated on the left as well, trusty calculator went into the wrong screen. There's the huge trusty calculator. Then we're going to say that 383,000 times 0.10, the 10%. So there's the 38.3 portion of equity that isn't ours. So that's it. And then we can say, note that we do have one more entry we're going to add here, and that's going to be related to that depreciation entry we saw in the past. So we're going to basically make the S's depreciation at book at the point in time of consolidation. Now, I'm actually going to create the balance sheet first, and then I'm going to do that with formulas, and then I'll go back in at the end of this, and we'll go back in and we'll make that last adjusting entry. That adjusting entry is just going to be debiting the accumulated depreciation and crediting the building and equipment for 6,000. That's going to be this 6,000 here. Okay, well, what would that look like if we were to make a balance sheet with it? So let's just make a balance sheet with this information. What I'm going to do on the balance sheet, so we could see the whole thing. I'm not going to do anything. I'm just going to make it just like this. So let's just type this thing out. I'm going to do this pretty quickly. Just to see the numbers here. The main thing we're looking for is the equity section. So I'm going to say assets, and then I'm just going to pull over the assets, which is going to be, I'll say cash, and then accounts receivable. Oh, that's not the right one. Computer did something funny. And then let's just see if we can autofill that down. If my autofill will work. Autofill. Land, there's like two more. My spell check keeps saying deeper there, but I want it to say depre. It should be depre, not DP or whatever they're trying to do. That wasn't me, that was the computer. And then we're gonna say this equals this, and then I'll copy that down. Let's just say Control C. And copy that down, and that'll give us the total. So we'll say total assets, and obviously we shouldn't have this account here, should be like gone. I'll just remove that because that's not on the balance sheet. That's got a zero in it because we don't need to include the zero balances and whatnot. So there's the total. Let's make this a little larger so we could see the total. I like to be able to see the numbers. Little preference I have, little preference. Liabilities, we're going to say the accounts payable. Let's bring over the accounts payable, copy that. Other liabilities, go ahead and indent those. I'm just bring those in a bit. And then we're going to pick up the numbers. They're going to say negative of the 81, negative of the 3 or the 2, whatever that is, and equals the sum of those. And that's going to be, let's call that total liabilities, and then equity, and I'm just going to say this is going to be common stock. And let's copy that down. I'm going to say Control C. And paste that here, and then we'll pull in our numbers. I'm going to say negative, and this is where the new thing is. This is kind of like the point here. This is the point of the whole process. Point of the process is this account right there. So there's the new thing that we kind of have to just that we put into the equity section of the consolidated balance sheet. And then that's going to be the total equity. And if we sum that up, we have that. And then we have the total liabilities and equity. And if we sum that up, we will then be balancing, of course, hopefully. Now, if I spelled anything wrong, I apologize. But the main point is, this is the new line item. So we you can see we consolidated the entire thing. We consolidated the entire thing, and that kind of makes sense because P kind of has control over the entire thing, even though this non-controlling interest has claim to 10%, the 38,300 of the net assets. So in other words, I mean, if P could do anything they want really with any of the assets of S, right? Because they can vote for it and have control over what happens. However, you can kind of think of it this way: if the company was to liquidate and you were going to pay out, then you would have to get then there would be a non-controlling interest of the 38,003 that S would have claim to. The non-controlling interest would have claim to. So it makes sense then, to some degree, if you're analyzing P, to analyze all the net assets that they have basically control to do what they want. They basically have the power to do what they want with the net assets. And it also makes sense to basically say, hey, look, there's 10% of those net assets that although P kind of basically has control over, if they were to liquidate, it's almost like a bond, almost like, they would have, there's 10% that is owned by S. So we're kind of representing that just down here in this line item in the equity section. Notice it's not represented in the assets here. It's not represented in the liabilities. They're just consolidated together. But in the equity section, we have this added line item. Now, in the next problem, we'll go to the next level of complexity and say, okay, now we did this right after consolidation. Let's do this a year later, where we actually have an income statement. We have activity that has happened after the consolidation point. Now, note we had one more entry that we didn't consolidate, and that's going to be this one with the accumulated depreciation. So remember, at the point of the consolidation, we would like to put it on the books in the consolidation at the book value at that time. So in other words, the consolidation, we want this to be represented for the building and equipment at the 201 here, not the 207 minus the 6, and then we'll depreciate it as we go. So what I'm going to do then is we're just going to say, let's do one more entry, which is going to be a debit to the accumulated depreciation to make it go away, and then we're going to be crediting the building and machinery, and that's going to be for this 6,000. So there's the 6,000 debit and credit, and we've seen this in the past. This isn't a new transaction, so we're going to say, all right, the accumulated depreciation, we're removing it for the S subsidiary. And then we're going to be putting it into the book value. So this 6,000 there, we basically removed, and then we netted it out into the building and equipment. So then we're going to be depreciating this book value as we go forward from this point forward. So that is that, and that will, of course, change these line items on the balance sheet for the accumulated depreciation and the building and equipment. So I did that a little bit late there, but hopefully that's not too confusing to add that one. We have seen that transaction through prior consolidation worksheets as well.